You're listening to OPIS Talks, where you'll be in on conversations with insiders in the energy, chemicals, and environmental commodities markets. Guests share insights into the latest trends and innovations, industry challenges, and much more. Let's dive into the conversations that explore where the energy economy is headed, right here on OPIS Talks.
Hello, my name is Mariana Santos Moreira, Thought Leadership Director at Chemical Market Analytics under Dow Jones Energy, and with me today is Maia Dolan, our Director of Americas Methanol. Welcome, Maia.
Hi, Mariana. Thank you for inviting me. Looking forward to exchanging some interesting facts about methanol with you. It's a wonderful market right now.
Yeah, lots to say for sure. To give our listeners a little bit of context, methanol market has particularly vulnerable geopolitical tensions recently, especially since the conflict in the Middle East broke out, since Iran is a major exporter of this product. So that's actually not the only market driver shifting for methanol. It's also heavily exposed to climate policy, the energy transition, to China's industrial policy, especially anything linked to coal to chemicals and olefins markets in that country. So there's a lot of levers being pulled in different directions. A very complex market to navigate nowadays. And Maya here will guide us through these issues, why they matter, and how it could impact methanol market outlook. Let's start maybe with trade policy and sanctions, and actually a little bit about Iran as well. So Maya, how are tightening US sanctions, especially those related to Iran, but also Russia and India, how are these reshaping regional arbitrages for methanol?
For the last couple of years, tightening U.S. sanctions have shifted trade flows. Let me give you an example by looking at Russia. Russian producers were forced to kind of redirect their stranded European methanol cargoes towards China and India. At the same time, U.S. exporters stepped right in and partially substituted these Russian volumes. We're talking roughly around 2 million metric tons per year directly into Europe. And it didn't stop there. U.S. exporters also found a growing market in India. Until then, India wasn't really considered an attractive market to the US because of the freight rates. Just didn't make sense. But everything changed after the 2025 sanctions against Indian traders of Iranian methanol, which stopped Iranian methanol flowing into India. That left a huge gap for the US to fill. But here's the twist that we're watching right now. The US just issued a temporary 60-day sanction waiver. It's known as General License X on Iranian oil and petrochemicals, which runs until August 21st of this year. So in the medium term, we might see global methanol supply spike as Iranian shipments legally hit the water. But, and this is a huge but, for anyone trading in the methanol market, there are some massive caveats that we have to keep in mind. First, the Trump administration could pull the plug and revoke that waiver early if geopolitical tensions flare up or if we see more serious attacks. Second, you have the compliance issue. Some Western banks may not want to process any Iranian-linked transactions, waiver or no waiver. Logistically, companies have to segregate that Iranian methanol to stay compliant. And finally, there's the what-if scenario. If sanctions are reimposed before you actually sold through that inventory, it's a total legal gray area as to how or even if that stranded methanol can be liquidated. So, long story short, Mariana, sanctions aren't just an administrative headache right now. They are reshaping the global methanol map.
That's a very interesting point that you made about the Iranian flows and the sanctions and being on and off. And that actually impacts China quite a bit, right? Because China was importing a lot of methanol from Iran. It has been for several years. I wanted to touch a little bit on the Chinese market because there are two different sides of the coin that are related to the situation in the Middle East that can impact methanol markets in China. On the one hand, you have coal to polyolefin mega plants and coal to methanol, and that usually captures strong margins when crude prices are high. Then at the same time, you have the methanol to polyolefin plants that import methanol, a lot of them from Iran, and that flow has been severely disrupted recently. So I wanted to ask you a few questions about this. And with the US-Iran deal potentially on the horizon, we already have a temporary truce in place. How do you expect this will shift China's MTO economics? And will it disrupt CTO and or MTO plant capacity? What are your views about these themes in China?
Right now, most of the coastal MTO operators, the one that relied on Iranian feedstock, are really feeling the squeeze. They're either running at heavily reduced rates or they just shut down completely because there is the lack of feedstock. And frankly, margins are really bad. To give you some context on how fast this is moving, operating rates in mainland China fell by about 17%, that's 1 7, just between May and June. It's a massive drop. Now, here's the real kicker. If these sanctions are permanently lifted, it actually flips the script. Iranian producers will suddenly get access to conventional global buyers again. That means that cheap, heavily discounted methanol that used to go to Chinese MTO plants will disappear. And if the price goes up, you can basically say goodbye to any future MTO capacity expansions. Because of that import disruption, we're likely going to see coastal MTO producers sprint toward feedstock diversification. They'll be forced to look in more long-term domestic coal-based methanol supply just to edge their bets, even while they keep trying to source imports. Meanwhile, the inland coastal based plants are going to dominate the market. Why I'm saying that? Because they're using stable local coal instead of imported methanol. So they completely avoid those price swings. But look, we have to keep the bigger picture in mind here. At the end of the day, MTO technologies struggle to compete economically against lower cost ethane based and probably even naphtha cracking. So it's a really a rough environment all around for MTO.
Right. You mentioned lack of feedstock perspectives. That goes beyond methanol itself, right? So let's think about the other feedstock, the petchems feedstocks. We know that methanol is made from natural gas. So the LNG markets and the tightness that we are experiencing right now because of the Middle Eastern conflict surely is having an impact in methanol, right? And what producer regions might actually benefit from the current dynamics? What is the near-term outlook for natural gas feedstock constraints in the major export hubs? How is LNG, how is natural gas reshaping the short-term outlook for methanol and potentially even long-term? What do you have to say about this?
If you look at the macro picture, the near term outlook for natural gas feedstock in the major export hubs is incredibly tight right now. We're seeing this double whammy of surging domestic power demand on one side, and on the other side, we have geopolitical infrastructure damage. Both are going to really limit global LNG availability over the next few years. Now, if the Middle East decides to prioritize its own domestic consumption or redirects that feedstock away from LNG exports, the global methanol markets could tighten a lot, which naturally is going to drive prices up. Now, if that happens, North American methanol producers are the ones standing to benefit the most. Why? Because they can leverage low cost domestic shale gas to capture higher export margins. At the same time, within the Asian market, Chinese domestic coal to methanol producers could step up and their coal based volumes would suddenly become highly economical substitutes for those expensive imports. But there is an interesting flip side to this. And honestly, I have to double check the exact numbers on how many methanol producers use LNG as a feedstock. But thinking logically, if the Middle East does cut back on LNG exports, that could leave more natural gas available for methanol production in the region, which may increase methanol supply and create a downward pressure on prices. We will have to wait and see how this dynamic plays out in the next few years.
It's very interesting that you're saying about leaving more natural gas potentially within the region. We've been talking about methanol made from coal. We just talked about methanol made from natural gas. Really, in the future, methanol could be an important part of the energy transition, right? I mean, we talked about this more a few years back. The energy transition is still evolving, maybe slower than it did before, but it's still evolving. So I think it's important that we talk about ethanol in that context. I wanted to understand which government frameworks are currently offering the highest monetization potential for blue or for green methanol premiums right now. And I want to understand how the current crisis is changing that landscape for low carbon methanol projects. Is there like a more localized regional shift? Is it more of a global impact?
Yes, if you're a project developer looking to monetize green methanol premiums right now, the EU is absolutely where you want to be. Hands down, Europe offers the clearest and highest monetization potential. And that's really being driven by a massive interconnected web of regulations. We have the Fuel EU Maritime, the EU Emission Tracking System, that's the ETS, the Renewable Energy Directive, RED3, and the RFNBOs, the Renewable Fuels of Non-Biological Origin Mandates. And of course, the backing from the Innovation Fund. So take Fuel EU Maritime, for example. That is officially a reality on the water now, and it directly rewards ships that lower their will to make greenhouse gas intensity. At the same time, we have the RED3, which is creating transport sector demand for those RFNBOs and advanced renewable fuels. If you flip over to the US, the story changes. The US looks incredibly attractive on the supply side. And that's mostly because of the 45V clean hydrogen tax credit, which gives you up to $3 per kilogram of clean hydrogen. But here's the catch, Mariana. That subsidy only supports the hydrogen input. It does actually do nothing to directly create a price premium for the finished methanol down the line. On top of that, you got this cloud of policy uncertainty surrounding the IRA tax credits right now. So when you compare the volatility to the heavily locked-in EU framework, it just makes the US market a lot less bankable.
I did not realize there wasn't necessarily support for demand in the US, that it was very much limited to hydrogen. That's a very good perspective, very interesting point. You mentioned that in Europe there is support for demand, and you mentioned specifically fuels, which brings me to my next question, and actually the last question I have for you today. It's about the maritime sector, because methanol can be used as a maritime fuel. So, also circling back to the current crisis, do you think this will be delaying the transition of the maritime sector to low carbon e-methanol?
It's very interesting because despite everything that's going on globally, the current geopolitical crisis aren't actually what's dragging down the timelines to transition to low carbon methanol. The real culprits here are a lot closer to home. We have a slow market adoption, high capital cost, and supply limitations for green hydrogen and biomass feedstocks. But here is something also very interesting. The shipping industry's commitment to this transition hasn't faded one bit. Driven by this massive urgent pressure to decarbonize, the big maritime conglomerates are still investing heavily in dual fuel methanol vessels. And they have to. Look at the regulations, like you mentioned, the Fuel EU Maritime. I mentioned the ETS. These strict compliance frameworks are tickling loudly in the background with completely unmoving targets. So ship owners literally cannot afford to sit on their hands. So what does that mean in practicality? Well, it means that we're almost certain entering a transition phase where operators will continue to build and will run these vessels on conventional methanol first. Then as the supply chains catch up, they'll make the pivot to low carbon e-methanol to avoid heavy non-compliance penalties. And honestly, when fossil fuels are expensive, the economics of making that switch to low carbon methanol look more and more attractive by the day.
Well, thank you so much, Maia, for joining me today and for sharing your valuable insights and expertise. There's certainly a lot more that can be said about every single one of these themes and their impact to methanol markets. So on that note, I'd like to invite our listeners to continue the conversation and be a part of the discussions shaping the future of the industry by joining us at the upcoming World Methanol Conference in Rotterdam, the Netherlands, from 29 September to the 1st of October. You can register now at chemicalmarketanalytics.com/WMC, so that's WMC for World Methanol Conference, and by using promo code TPOD15, that stands for Thank You Podcast, so TPOD15, and you'll receive an additional 15% discount on your registration. And Maia will be there, and I will be there. And thank you so much for tuning in, and we hope to see you in Rotterdam. Bye.
Bye-bye. Thank you.
We hope you've enjoyed today's insider conversation on OPIS Talks. Join us next time for a deep dive into another industry insider's world. You can find more OPIS Talks episodes at opisnet.com/podcasts or wherever you listen to your favorite podcasts.